In a move that reflects the dramatic impact COVID-19 has had on global markets, the US Federal Reserve slashed borrowing costs for the second time in 2 weeks. Its benchmark interest rate is now at a 5-year low between 0 and 0.25%, a move that's been welcomed by President Donald Trump.
People in the market should be very thrilled, and that brings us, we're the strongest country in the world by far, financially and every other way. And that brings us in line with what other countries are.
The Fed also announced a quantitative easing program worth $700 billion as part of its efforts to cushion the economic blow caused by coronavirus. But it hasn't stopped nervous investors around the world from selling many of their shares. The S&P 500 lost 1/10 of its value on open, triggering a circuit breaker which pauses trade for 15 minutes. The FTSE 100 fell more than 7%, bringing its losses since the start of the year to 30%. The Frankfurt and Paris stock markets were also down by more than 4%. Asia followed a similar trend, with Tokyo's Nikkei 225 dropping nearly 2.5% and Hong Kong's Hang Seng 4%. Mumbai's Sensex also tumbled by more than 5%.
As I'm talking to you, Sensex is down by 1,500 points. Two reasons. First is US Dow Jones future is down by 5%. And second reason is number of cases in India of COVID-19 confirmed cases are going up.
The downturn has been caused in part by a slowdown in the services sector due to recommendations that consumers keep a healthy distance from one another. A number of central banks across the world are taking joint action to lift investor confidence. The Bank of Japan followed the Fed's actions by announcing its own emergency monetary policy measures, including ramping up its bond buying program.
The spread of the new coronavirus infectious disease has an impact on Japan's economy through a decline in inbound tourism, as well as on exports, output and consumption. The number of entries to Japan has dropped sharply, mainly with a decline on Chinese visitors. Exports, mainly to China, have fallen too.
But as cases of COVID-19 continue to rise, it's feared the measures may not be enough to prevent a global recession. Shamim Chowdhury, TRT World.
Well, for more on this, I'm joined by Matt Maley in Newton, Massachusetts. He's the Managing Director and Equity Strategist at the trading firm Miller Tabak. Welcome back to Money Talks, Matt. Now, US President Donald Trump finally has his near zero interest rate, something that he's been calling for quite some time now, albeit it's happened in very unfortunate circumstances, a global pandemic. But why are investors not relieved by what the Fed has done?
Well, Oscar, I think it's a couple of different reasons. Number one is that people really got worried about the how dramatic this rate cut was. I mean, they had a meeting coming up just this week anyway, Tuesday and Wednesday, with a rate announcement on Wednesday, and yet they couldn't even wait that long. Just 2 more days before they announced their rate cut. And on top of that, they cut the rates not just by 50 basis points that a lot of people were looking for, but by 100 basis points, a full percentage point. So people are starting to say, oh my gosh, are things really that much worse than we think they are? So in a way, it's kind of like they caused this sell-off to a certain degree, but that doesn't mean it's the wrong move. I guess my point is, maybe they're causing a little bit of short-term pain now and preventing, more pain down the road by making this drastic move.
Yes, now part of what the US Fed has announced is that they're pledging to spend upwards of $700 billion in the form of financial stimulus into the economy. Do you think Jerome Powell has done the right thing here, not only slashed interest rates, but also promised this stimulus, similar to what we saw during the financial crisis?
Yeah, I do. I think it's something that, again, today it's not helping us much, but I think over time it will. It gives the people confidence that that they're not behind the 8 ball; they're getting in front of it. And that's been a big criticism just a few weeks ago, that they were really, behind, falling behind the situation. What we need now, of course, is that a lot of people are looking for something more on the fiscal side, and because people need, we know that the Fed intervention is not going to contain the coronavirus, and that's a whole completely separate situation. But fiscal policy, that can put some money in people's pockets. That can keep them, give them a little more confidence that they can, ride through this situation. Put money on the table, pay their mortgages, and things like that, and not have to sell stocks because they're afraid they're going to lose their job and they need to cover any of their costs.
Now, as we know, many stock market pundits see times of crisis such as the one we're in now as an opportunity to get into the market. Do you think now's the right time to get in there, or will stocks fall even further?
Well, I don't mean to talk out of both sides of my mouth, but I think it's both. What I think, I had been saying that the market, people should raise cash back in February and back in January and well into February, raise some cash so that if the market did fall hard, they'd have some cash on the sidelines to be able to put it to work. Well, that's worked out quite well. The question is, you can never, the key is you can never by the absolute bottom. So start to pick away at your favorite stocks, especially the high quality names with good balance sheets, a lot of cash. And then if you don't want to try to buy it all at once and pick the absolute bottom, you can buy a little bit more if it goes a little bit lower, and then a little bit more if it goes lower than after that. The point is, I do think it's a good place to tip your toe in, but not to jump in with both feet, because this bottoming process is going to take a while.
Okay, Matt Maley, Tabak in Massachusetts, thank you for your analysis as always.